we could get started. My name's Akshay Shrimankar, the CPA and the CEO of Shay CPA. I'm doing the presentation here with Mike Dombrowski of InterPrime. I think Mike could probably just introduce himself.
Yeah, sure. My name's Mike Dombrowski. I'm the head of capital markets at InterPrime. My background is finance, Wall Street. The last 10 years or so, I've been helping large banks manage their portfolios. And recently, in the last year or so, I've transitioned over to InterPrime, where we kind of help startups and small to medium-sized businesses manage their cash flow and their treasury services, and kind of walk you guys through some both theory and practical application of that stuff, and kind of educate you and help you find some value in this and be able to apply it to your business.
Perfect. Yep. So I'm just gonna.
Perfect. So yeah, I'll start off here. One of the things that I always like to start with is there's tons of information on personal financial literacy for individuals, but there's little to none out there in terms of corporate financial literacy, is what I call it. So I like to try to do these educational things or web posts or content and marketing type of things to kind of educate people, because I find that education is one of the biggest hurdles for startup founders, new founders, etc. So first things is, why do you need to understand cash management and treasury, right? Effective management of your cash leads to security, liquidity, and returns on your cash. And this in turn does two things for you, right? Number one, it helps your business succeed. And number two, it shows your investors, assuming you have them, that you are serious about the funds that you have received, right? So when it comes to like an educational thing, one of the main things that we always see initially with a new founder, and just because of lack of education, is sometimes when you raise some funding from your friends and family or your venture firms, what happens is they tend to take the cash, plug it all into one bank account, and consider that cash management, right? Overall, that is not really cash management. And what a lot of people don't understand is that even just that simple type of move, what makes you feel comfortable, does expose your capital to risk, right? So FDIC protection out there, anything over 250K in a single bank account goes and opens yourself up to potential risk and loss. Now, obviously, most banks, just in this particular thing, are not going to be under stress. But as we remember from 2008, there was some stress there and banks did close. So if you don't even know that type of stuff, you may be opening yourself up to risk. So that's just like a little nugget to start off with and to kind of be in the back of your head as we kind of go through some more of this information. So what is cash management and treasury? The academic definition is it's the process and structure of managing your corporate cash flow. I like to keep it a little easier and say it's just basically getting your money to where it needs to go. However you do that, that's the simple basis of it all. Inside of all that, there are 4 different goals that you're trying to accomplish. And if you've read any of the stuff that I've put out there on the web or seen me speak about this subject before, it might be a rehash for you, but they're very important, right? Number 1 is you always want to make sure your corporate cash is as safe as possible. I always say safety over everything, right? Number 2 is make sure your cash is liquid when it's needed. Otherwise, if it's not, and you come across, you need to do a large purchase order, or you possibly want to do an acquisition of another company, if you can't actually get to your cash, it's basically worthless. Your third goal is always to make sure that your excess or idle cash can possibly earn you a reasonable rate of return without unnecessary risk. If you're able to use your cash to make you more cash via income or something like that, a return on your funds, that can help offset expenses, maybe get you an extra engineer, etc. So that's something to be mindful of, right? And then your fourth goal is to track and plan for your future. So forecasting, cash flow analysis, etc. Akshay will touch on some of that stuff a little bit later in the presentation, but those are your 4 main goals. I'll let Akshay touch on this because I love this picture and it kind of goes right to my thing, safety over everything. So go to Akshay. You're on mute, brother.
Thanks, Mike. So I think many folks are familiar with this quote, revenue is vanity, profit is sanity and cash is king. And I think for many early stage tech founders, often, the metrics are growth numbers and number of users, and making sure that you have monthly recurring revenue. But sometimes what often goes overlooked is that without having the cash in the account and the cash protected, nothing else is, nothing else is going to be as important as that. So yeah, so I always I like this image with Scrooge jumping into the
Yeah, I love it as well. And I don't want to totally date myself, but I can remember watching DuckTales and Scrooge McDuck, the original version, many moons ago at right after school. So when we decided to use this image, I was loving it. So that's right. This is another good one. Back in July, I wrote a blog post called "Don't Blow Your VC's Money." The whole purpose of that was not only, wasn't intended to be like a clickbaiting title, but the whole point of the blog post was to illustrate the responsibilities of cash management and kind of say what they are and what they are not, right? So this picture exemplifies exactly what it's not. You don't want to take your investors' money from friends and family or venture firms, etc. Load up your money gun, go to the club, and make it rain, right? YOLO with your investor cash is not the goal, right? But inside of cash management, a lot of people like to use the stool analogy with 3 pillars or 3 legs to kind of make things structurally sound. So I'm just going to go ahead and do that with cash management. The 3 main things that you're going to kind of focus on, first is transaction management. And that's simply just making sure your transactions occur in a timely manner and correctly. If you're not paying attention to this stuff, either daily or every other day, et cetera, whatever the cadence ultimately ends up being for you, you are going to potentially have some offsite errors and delays, right? So another way to kind of think about transaction management is, and I know a lot of people have seen this, is if you're in New York City and you're at a 4-way intersection and everybody's bumper to bumper, all these people or transactions need to go where they need to go. However, if you don't have someone potentially like the traffic officer in the middle directing people, things are not going to work out smoothly, especially if one of the lights goes down, right? So kind of think of transaction management in that of getting from point A to point B with your funds. Some directly related tasks inside of that are effectively managing your bank account, again, tracking your payments, collecting your funds, maybe establishing and maintaining lines of credit. The second stool leg, if you will, is called balance sheet and liquidity. This all revolves around noting how much cash you have, where it is placed, and when it's going to be available, right? If you don't have enough cash on hand, especially if you're in like the DTC space, or you need some buying products from suppliers to actually make your business work and generate revenue. And if you don't have that cash on hand, big no-no. You can end up having a supplier payment not being met. This in turn slows down your business. This in turn, maybe have you lose some revenue and maybe ultimately lose a customer, right? So things like that, and being on top of your balance sheet and knowing where your cash is very important. Some simple tasks that you're going to ultimately want to take note of in this section are, tracking your balance sheet, which seems to be pretty daunting for a lot of people, but we can discuss, how you kind of manage that later. Monitoring your operational cash or surplus cash. And, again, if you're dealing with suppliers, you may need to determine chain financing, et cetera. That kind of completes the cash management stool, revolves around risk management. I always want to think that risk management should be number 1 out of all these things, because again, remember, cash and safety over everything, right? So you need to start thinking about risk management, how to implement some risk management protocols, because what they'll do is they will signal to you warning signs before there are fires. So another good way to think about it is, everybody's car has a check engine light. Depending on how studious you are on that, when it shows up, you should probably make a immediate beeline to your mechanic to see what's going on, because if that's not addressed, it could turn into a bigger problem. Same thing with your risk management and your corporate cash. If you have the proper protocols in place, you'll see something's not actually working properly, then you can go ahead and address it before it turns into a bigger problem. So a couple quick examples to kind of plant the seeds, right? Credit risk. So should you be using the bank you're using, right? Is your bank well capitalized? What type of loans do they make? Are there better options for you, right? You need to kind of explore those type of things because not all banks are created equal. Market risk. Do you have lines of credit? Are you using credit cards? Do you know what your interest rates are? Do you know how they're moving? Do you do business across international lines? So you got to start thinking about currency risk, how currencies are moving. And then the last one I'll touch on before I pass the mic to Akshay, so you can kind of get into some other, couple other things in the risk management side, is liquidity risk. Especially if you're using credit, debt lines, revolving lines, credit cards, et cetera, whatever you want to call them. You need to know how deep you are going into your available balance. And there are ratios that kind of help you determine that, like debt ratios, et cetera. But even just being mindful of what the ultimate line is, where you're standing, and checking it frequently helps you immensely, because if you don't have that cash you need, you may need to tap that. And if you are bumping up on your balance line or your credit line max, you could be put into a pretty tough position if you need to get something done pretty quickly. So that kind of is an integral part of risk management.
Yeah, so just touching on risk management and some of the things that, from our perspective, from the accountants, that you can do to protect your cash, especially once you raise either a seed round or a Series A round. There's a few things that you can do with the bank. So, one of the common areas to prevent fraud would be something like positive pay, where you would either have an ACH debit block or a way to communicate to the bank the payments that are going to be going out to vendors before you actually so there are no payments just going out without the bank knowing ahead of time. So I think that's like one that's relatively straightforward to do, and once you get started down that path, it can become automated. Two-factor authentication, which is very common today, but I think what ends up happening is, if you don't implement it across all your financial systems, whether it's the bank, the accounting system, and then the different spokes of the wheel that connect to your accounting system, there could be just a gap in the in the way that things are done. So I would just say that having those two is a big one for Series A. And then, regular bank reconciliation and segregation of duties. I'll get into that more later. But the other thing that we're seeing a lot with are email phishing scams, especially to tech founders. Tech founders' information is, by and large, very public. You can see founders' names on Crunchbase website or AngelList in different areas, and people know who you are. And they know when you've raised money. So it doesn't take a rocket scientist to target founders, and they are a target. So having making sure that any communication of any sensitive information like social security numbers, corporate documents, bank account numbers, routing numbers, all go through some sort of a secure email or through a secure portal, I think is critical for founders to take into consideration, because they are kind of like a public target and very early on, especially for founders that get some PR or press, or maybe you have done a Kickstarter campaign that's got you some visibility. And then using reputable banks and monitoring FDIC limits. So, the FDIC limits are, Mike will probably expound on this, I believe $250,000 per individual bank institution. And very often, like the average Series A round is $5 million plus, right? So if you're keeping that all in one bank account, you're blowing past that limit very quickly. So you want to make sure that the banks you're using are reputable, and that that you're protected in that space. And just one little sort of story about cash and not protecting yourself is this company called Zirtual. So Zirtual was a previous competitor to Upwork, which is now the popular place to hire freelancers. And their model was to hire US-based freelancers for $15 an hour, which became expensive. What ended up happening is they didn't have an internal CFO. They were using external CFOs, and they completely missed out on their projections. They didn't fully have an idea on what their runway and their burn rate was. And basically they woke up one morning and they were completely out of cash. And this was a company that had got past Series A, and this had happened in 2015. They had to do an urgent fire sale on the company, and it's kind of looked at now as a story of what not to do. They were sort of grew very quickly, very fast, and they were it was almost like they were a victim of their own success in many ways, because they were a very popular service. So with that, I'll pass it over to Mike, who can talk about the systems that make the world go around.
Sure. That's such a crazy story. When you brought that up to me, it's so funny. I forgot about that one, or maybe it was just didn't even know it, but crazy. And stuff like that happens all the time, so it's not totally shocking. So back at pre-COVID, right before COVID, I was in Madrid, Spain, and some of the outside areas, and I saw my first view of one of these aqueducts. This is not my picture, but I have one similar. And what it makes me think about, right, and this is like hundreds of years ago, the effort and the technological advancement that they were working on was only accomplished by having systems in place, right? Our air traffic, our trains, highway systems, water systems, just like the aqueduct, everything works off a system that makes it happen, right? Your cash management is no different. So I'm just going to walk through some points here, what I call structural points of cash management. They're going to kind of give you some ideas about what you're going to need to have, what to think about moving forward, as you can learn some more here today, and then kind of maybe build out what your initial plans are, right? The first thing, which I'm always thinking is the cornerstone, the foundation, it's called your policy, right? And what your policy is it's your playbook or your roadmap about how you're going to manage your cash, right? I'm going to dig into much deeper in a little bit, but just have that in your mind. The second thing is objectives. Every plan needs to have objectives, benchmarks, metrics, goals. Otherwise, what are you doing? You can't even measure if it's working, right? So what are your goals? What could your goals be? You need to have more cash on hand. You're trying to lower your debt ratio. You want to shorten your cycle of receiving your cash from your customers. So that you got to have these benchmarks. Otherwise, what are you doing, right? The next thing is service providers. A lot of people probably on this webinar, or are going to see the replay, they're probably going to be small, pre-seed, seed, Series A, right? They may not be willing to take on headcount or expense to bring on a dedicated finance manager or a CFO. But that doesn't mean that the help's not out there. There are specialized teams that you can tap to get the knowledge and the expertise that you need. And a lot of times, it not only offloads your labor, right, or the workload, but they can be attained for cheaper than taking on somebody full time. So someone like a Shay CPA that directly works with startups, fractional CFO groups. I mean, not a plug, but InterPrime, we kind of help along with all this stuff, right? So there are teams out there that you need to look to if you don't want to take on full-time help, right? Next thing is banks, right? Banking is a business, and we all need to have bank accounts, right? But again, all banks are not created equal. So you may need to have multiple. You may need to have 2 in your country of residence or business. If you're doing international payments, you're probably going to need to have an international bank. And you need to review these relationships, right? A lot of people become very complacent. They find a bank that they feel like they like, or they're getting a good rate of return on something, and they just stick with them, right? Over time, things change. One of the things that we see quite frequently at InterPrime when we deal with founders and early stage companies in terms of cash management is they'll come to us and they'll say, hey, I'm working with XYZ Bank. 6 months ago when we signed up with them, we were getting paid this on our excess funds. Well, over time things change, and lo and behold, that rate that they were getting is now basically zero. And it's not because the bank is trying to take advantage of them. It's because the Federal Reserve sets interest rates, and interest rates change. So, you need to review these things periodically, and don't be afraid to change a bank if the relationship is not providing value to you anymore. I know it can be a pain to change, automatic payments and all that type of stuff. But you do need to review them. And if it still makes sense for you, keep working with who you're working with. If it doesn't, explore other options and kind of weigh your pros and cons. And then the last ones, I'm just going to lump these together and then let Akshay get a little more into it. It's processes, controls, documentation, and accounting, right? All this gobbledygook of those words is all revolving around preventing loss, errors, not repeating your errors, and reducing fraud, right? In the world of cash management and business, there's cash management and then there's your accounting team. It is very important, and I like to stress this pretty heavily, that your accounting team needs to be a very good partner and have a great relationship with your cash management team. They both can be great, but when they work together, the power of awesomeness goes 10 times. So make sure that the systems that you have in terms of processes, controls, and all this type of stuff with your accounts and your cash management team is tight. So I'm going to let Akshay get into a little bit more of that right now.
Thanks, Mike. Yeah, so I think today most accounting systems are cloud-based, and the level of technology available to small businesses and early stage founders, it's pretty mind-blowing. The fintech that has grown over the last 10 to 15 years. And what this is sort of allowing founders to do is to have very much a finger on the pulse of their business at any moment in time. The banks are speaking directly to your accounting system. The bill pay system will be talking directly to your financial system. Also, services such as InterPrime or other financial institutions where you may be keeping any money, they're going to be talking to the accounting system all the time. So you want a modern accounting system that is cloud-based. With that do come some security concerns, and you do need to make sure that the users on those accounts are the ones that you want. Very often what we find, especially with early stage founders, is they may have had co-founders who have left the company, and and sometimes they still have access to their existing accounting systems. They also have prior accounting firms still on their system. So it's something, as Mike touched on, that needs to always be reviewed periodically. And then I think you really do need to have, especially once you get past that seed round, regular bookkeeping and bank reconciliations. And that's really going to be the best way to keep an eye on any fraud. And the other thing is, as you do sort of chop and change people in your team, what you'll find is that you're going to be subscribing to different subscriptions, different services that you may not even be using, or it could be something that a legacy person was using. And it's a good idea to just monitor all of that, just so that there's not that excess bleeding of cash. And the way that most SaaS-based businesses bill now, you're usually paying for an annual subscription every year, which could be a tidy sum. And if you're not careful, those are usually on auto renew. So they'll just go straight onto your credit card, or if you have a debit card linked, they'll go straight on there. So just having an eye on that is critical. And that way you can make sure that your burn rate isn't adversely impacted by that. And as Mike mentioned, those dips in the interest rates, which are set by the Federal Reserve, if you are doing your accounting every month, the interest income line is something that you're going to want to keep an eye on, and that will be a quick indicator to see, or either a rate expired, or you are now, you're not getting that additional ancillary income from interest. So yeah, that was an excellent point Mike brought up.
Perfect. Now we can kind of get into a little bit more, what do you want to call it? Rubber meets the road type of stuff. So circling back to the cornerstone of all cash management and treasury, I always let's say it's the investment policy, which we touched on briefly. So what exactly is an investment policy? I say the investment policy is your blueprint or your playbook that the cash management team needs in order to do their job. Okay, it's going to outline things like your corporate cash concerns, how you're going to be handling them, explaining explicitly your controls on these systems, and always, again, mitigating risk, right? So some key points that you need to know about when thinking about instituting an investment policy is it needs to be flexible, and it needs to be able to be updated as your company grows or as your objectives change, right? So if you're putting it in, instituting an investment policy now and you're a pre-seed or a seed or Series A company, whatever it is, over time, your company is going to grow and it's going to need to change, right? Your growth trajectory is going to change, your objectives are going to change. So again, it needs to be flexible for these updates. So how do you do that, right? You got to keep the language simple, straightforward, and specific. The reason you do that is it minimizes confusion. How you write, or however whoever's going to be building out this policy writes, may not be easy and direct for somebody else. So that you have to, in your mind, think about writing it for a fifth grader or less, right? No big words, no jargon, etc. Try to keep it plain Jane, straight to the point. And an easy way to kind of think about that is the old acronym KISS, right? So keep it simple, stupid. That's the easiest way to kind of make sure the language is correct. So now I'm going to go into a little bit more deeper on the investment policy and kind of talk about what the components are. So just like this picture is showing you here, an investment policy is the foundation of your house, right? Or your building, right? The foundation is great. It's the first building block, etc. But beyond that, everything you add to it and the components of your investment policy is what's going to make it stand as tall as possible for as long as possible. So I'm just going to walk through a couple components that are inside almost every investment policy, just to kind of give you an idea to start thinking about what's going to be inside of that. So the first one is cash requirements and forecasting. Again, this goes back to cash over everything. You need to know how much cash you have on hand and when more is available, right? So that's number one. The document is going to explain, as an example, I want to keep 3 months of burn in my operational account at every time, 6 months of burn, whatever it is. It kind of depends on your company, how much your burn rate is, etc. And to be completely honest, some of the founders and business owners I've met with across my whole career, some like to run a little tight to the bottom line, some don't, right? So it's kind of a personal preference, but that's one of the very first things you're going to put into your investment policy.
Yeah, and just if I could interject there,
yeah.
Mike, with I think one of the things that sort of underlies this is that when founders receive funding, they have they kind of have a picture in their mind. Okay, this is going to be for 18 months. So what's the point of shifting the money into another account and earning a little bit of it, what they think would be just a little bit of interest? But I think it is your fiduciary responsibility as a founder to make the most money out, whilst you have it on hand. And if you think if you're not going to think about that, it's gonna cause an issue eventually, because someone's going to say you're not being a good steward, right, of that cash. So I think all it really takes from a founder perspective is to set up those additional accounts, and then being careful with the way you time those drawdowns, right? So that when you do need that cash for operations, you can draw down on it on an optimal way to make sure that you're still earning a good rate of return on that money, and at the same time being able to cover operational expenses. So yeah, just wanted to quickly jump in on that.
Yeah, 100% agree with that. And it's going to be great when you walk through your examples later. So that should be great. Perfect. Thank you. A couple of the other ones here, you're going to have a statement of purpose. That's basically just going to tell you, what is needed to be maintained, right? Are you doing all this to make sure you have liquidity for your expenses? Is your focus, because you're a little bit of a mature company, you're looking to earn some more return on your idle and excess cash? It's kind of where you make those determinations. And then coupled with that, it's like your investment objectives. The purpose of all of that is to kind of look at everything holistically, right? So what is your overall objective? Is it to preserve your capital, cash over everything? Is it to earn a little bit of income, right, on your excess funds? Maybe, for somebody that's in the international space, do you need to hedge your currency exposure or hedge your currency risk because, maybe you're buying in yen and you're selling in dollars or pounds or whatever it is. That might be your objective of your holistic plan. Risk management, which I'm always big on, but all risk management and managers are not equal. Why is that? If you have a longer time horizon over a shorter time horizon, you may be able to be quote unquote a little bit more risky with how you're managing excess cash, or maybe not needing to have as much in the operational account as you need, right? How experienced are you? Are you a second-time founder? Does someone on your team have a finance background? Is it a whole bunch of MBAs hanging out, running this company? If you have some experience, it's going to kind of dictate your level of risk management. Investment options. Now, this is basically where you're choosing to have your excess and idle cash go to work for you, right? So again, everything being in your bank account is not ideal. We've kind of talked about that. So what can you look at? A lot of people look at T-bills, U.S. government T-bills, bank certificates of deposit, high-grade investment corporate bonds. But at the same time, you're also going to have something that's called prohibited investment options, right? So you're probably not going to be looking to put your money into individual stocks. You're probably not going to be trading options or futures unless you maybe do on commodities. You're certainly not going to be buying Beanie Babies or Air Force Ones or art, right? Those are extreme examples, but those are probably going to be in the prohibited list. The next one is pretty important. It's called custodians. And if you've never heard this term before, a custodian is in business to keep your assets safe and secure. They also work on settlement of trading transactions and also help you with reporting. A bank can be a custodian, but there are also third parties out there that also do the same function. So one thing to think about between a bank and a third party is, the third party is probably going to be utmost at a fiduciary responsibility to you. They're not going to have a conflict of interest, meaning that they're not going to be trying to sell you new accounts or investments or all this other type of stuff. I'm not saying all banks are going to do that, but a quote unquote disinterested third party as a fiduciary or custodian does go a long way. So I strongly recommend not only exploring with your banks, but also with the third parties. And then the last one, I kind of keep lumping a lot of the last ones together because it's perfect for Akshay to hit. It's roles, responsibilities, and compliance. All those will probably generally be individual line items in the investment policy. However, just for this, we're going to lump them together because they all kind of do the same thing. And that outlines who is in charge for what and what they can and cannot do, right? So some of these things here, everybody's not going to be able to manage a bank account. You don't want everybody to have that access. It's just as an example. I'll let Akshay get into a little bit deeper. So one of the other things is going to talk about compliance. How often are these compliance reviews done? Who is doing them? Most teams or most companies will have an internal person or team that kind of does all that. But something that you're going to want to think about is you may also want to bring in an external team. Again, why? I call it check the checkers, right? Everybody has an internal person that's doing the checking and the risk management and the compliance. But if you have an external team also in conjunction working with them or overseeing them or checking the checker, it's going to help you greatly reduce the potential fraud. And nobody thinks that their internal employees are going to do something crazy. but you never know that. And it's always better to be safe than sorry. So I'm going to go ahead and let Akshay jump here and talk about some of the roles, responsibility, and compliance stuff.
Yeah, so that's an excellent point. I think with roles and responsibilities, most of the tech companies that incorporate with the state of Delaware, they usually need to specify who the secretary is, who the treasurer is of the company. So, that by default is sort of like in your corporate charter. But when you are thinking about, especially if with the proceeds from a seed or a Series A fund, where to put that money, it may be beneficial to set up an investment committee at the board level, and this could also be a way to attract board members that you may want to have on your team. If there are certain people in the finance world that have experience with this, it would be like almost act as a steering committee, so that if you were to use an organization like InterPrime, there is someone looking at it at the board level. It also sort of promotes board participation beyond them just, for many early stage founders, a lot of the board participation is very much product heavy and looking into the product development cycle, and then also helping with establishing relationships with customers. So this could be just a slightly different look at the company, and it also shows the board that you're committed to being a good steward of the cash that has been entrusted into the company. So I think it does nothing but generate goodwill, as long as you could get buy-in from your board members that this is something that may be important even at an early stage to do. Definitely at later stages, Series B and beyond, once you become a public company, it's critical and it's required, but it could be something that you want to do a little earlier on, if there's a little buy-in at the board level. And then I think co-founders themselves can hold themselves accountable, setting up approvals. When it comes to setting up your bank accounts, now there's no such really no such thing as checks anymore, and everything is going through ACH. You may be using a service like Bill.com, or you're sending out wires. So I think if there are payments going out above a certain threshold, you may want to have the CEO, COO, CFO sort of approve those. So many of those are on auto pay, especially if you're using a payroll service like Gusto or JustWorks, that it can become out of sight, out of mind. But I think you need to, founders definitely need have a responsibility to be monitoring those payments. And again, that sort of goes back to the accounting system and making sure that you're reviewing that. Also, auto pays, as I mentioned before, it is a danger to leak cash, especially when you have, like, let's say, like a Slack subscription with 20, 30 users, and it just automatically renews every year or every month. So just monitoring those subscriptions is important, because many of them are sort of paid for on a per seat basis. So yeah, I'll let Mike go into the next slide.
Perfect. Yeah, this is now we're really getting to the crux of the rubber meets the road type of stuff. You just kind of got some insight into the investment policies, etc. I'm sure a lot of you are probably thinking, wow, this seems pretty daunting, time consuming. I may need to get some outside assistance from maybe a lawyer or a CPA, etc. That might make you think, not only just from being a time suck, you might need to shell out some cash, right, to get the help that you need. So what we tend to see is if people have that attitude, the founder will say, hey, I'm going to kick the can down the road. I'm going to wait till I have some more money. Our opinion, in my opinion, is that's probably the wrong course of action. Reason being, if you set the groundwork now, right, with using the analogy of the foundation of a house again, you set the groundwork now. If you do it properly, the language will be moldable. And then as your company continues to grow, you can go ahead and adjust it, right? So what we did, and kind of making a little bit of this easier for everybody at InterPrime, is we spent probably the last 6 or 8 months, it's probably more towards 8 months now, we were heads down working with some VCs, lawyers, CFO groups, CPAs, And we created something that we call the Standard Investment Policy for Startups, also known as the SIPs. One way to think about it is it's an open source document. It's able to be implemented within 10 to 15 minutes. Most of the legwork is already, almost all the legwork, I would say, probably 99%. The legwork is done for you already. And you can use it with or without InterPrime's help. When we do the rehash later for the webinar link and all that stuff, I'm going to put the links in there for you to go see it. But you just need to think about it as this, right? If you want to start with an easy thing, check out the SIPs. You could probably implement it, and it's definitely customizable, right? So what's already there is going to get you probably almost all the way to where you need to go. And then if your certain company or your views maybe need some adjustments, it's going to 100% be easily added to the Standard Investment Policy for Startups. And that's a quick and easy tool directly after this that you can use. And I strongly recommend you check it out. I know Akshay's did a great video about it on LinkedIn that you can check out and kind of walks you through it a little bit and his take on why you should use it. So make sure you look at that. And I'm now going to pass it back to Akshay so he can walk you guys through some applicable tasks of burn rate, runway, and all that type of stuff. So over to you, sir.
Yeah, so I thought I'd just end up close out, I guess, our side of the presentation, just talking a little bit about burn and runway, and just walking through a couple of these sort of metrics that I think founders need to understand and just keep an eye on. So, what is, we spoke about burn and runway, but what is that? It's a rather simple calculation. It's really, your burn is your beginning cash balance minus your ending cash balance. And for many early stage founders, tech companies, that's you're usually having less money, right? From when you started to when you ended, because of the operational expenses and the research and development expenses that are happening early on in a startup's life. So I just wanted to kind of demystify that, this rate, or this burn rate, is not the most complex calculation. It's something that you could sort of do by looking at, your total, all of your bank accounts. And the other aspect is the runway, which is the time, which is a function of how much time you have left with the amount of cash you have, is really your total cash balance divided by your burn rate, right? So, one of the metrics that we sort of send to founders each month it is sort of that, right? So here's an example of what we would send to a client, like the cash in bank, the average monthly cash burn, the predicted months of runway that they have left, and when the cash out date based upon how much cash they have. So this is sort of like a typical one this is like a seed stage company, and you can see they have like 18 months of runway based upon the amount of cash they have and their burn rate. So just wanted to demystify some of this stuff, and also show that, founders who may not have enough time to work on this, that's what firms like ours are here for, in helping you sort of just get a snapshot of your cash and help you understand when to do your fundraising and how to plan around it. And I think using a company like InterPrime, what you're really trying to do is extend that runway as far as you can, right? So having the right partners in place will help you do that. So so I just wanted to go through that. And I guess we could probably at this point, unless Mike has anything else to say, we could probably open it up to Q&A.
Yeah, no, I think we're actually right on time for Q&A. So we did perfect there. So if there's any questions, we're more than happy to kind of answer them and go from there. Anything on your side, Nina, that you see?
I'm not seeing any questions in the chat at the moment. People can unmute themselves if they want to ask a question verbally, or you can throw it in the chat if you like.
Yeah, sorry, Hezron here. I've got a quick question. Really good, really insightful, actually, really helpful presentation. So thanks a lot for starters on that. But so we're a UK-based company. We've been going for a few years. We do have an American affiliate now incorporated in the state of Delaware, funnily enough. And so I guess a lot of the stuff you talked about is quite applicable in the US market. And in particular, the SIPs document, I'll be really keen to take a look at that after, so that I'm really looking forward to seeing that. But how applicable is that across international sort of lines? You know, does it need a bit of tweaking if we're talking about the UK market, or maybe in Asian market or something like that?
You're talking about in terms of the SIPs?
Yeah.
Or in terms of the SIPs, I mean, generally speaking, and I'm not a lawyer, nor do I play one on the internet, but generally speaking, an investment policy or the SIPs is primarily an internal document only, right? So generally speaking, they tend not to be like a legal binding contract. It's more something internally. So, you know, without, you know, again, playing a lawyer, a lot of it should be applicable to you. But on your side, if you wanted to use something like that, you might just want to have it glossed over by your counsel.
Sure, thank you.
Anyone else? I think we're good. I think we did our job. What do you think, Akshay?
Yeah, thanks everyone, I think, for joining us. And I think we have our contact info here as well. And there will be a recording available that we'll probably send out to everyone. Yeah, you know, I think from our side, we thank you all for taking the time to learn a little bit more about cash management.